Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. Today I discuss the Great Credit Crunch. My first blip reiterates my opinion that we are in the early innings of the Great Credit Crunch. The media has been giving a positive spin to the fact that many large U.S. financial corporations have raised more than $28 billion in capital in recent days. The spin is that since capital can be raised, the sector is poised for a strong comeback. I disagree. There are many more bad loans to be discovered around the world in upcoming quarters. You just can't glaze over $165 trillion in notional amount of derivative contracts just among the FDIC-insured financial institutions and more than $500 trillion globally. Listen to bank CEOs. Bank of America, for example, expects negative factors to continue right through 2008. My second blip shows the daily chart for the Residential Housing Sector Index, HGX. The daily chart for HGX shows the year-to-date low at 117.41, with the 50-day simple moving average at 139.88 and the 200-day at 153.84. Builders and developers are having problems repaying $629 billion in construction and development loans to community and regional banks. Many projects are on hold, and for completed project, potential buyers cannot get mortgages. Lenders in some locations have become reluctant to lend, giving the risk that property values continue to decline. My third blip shows the daily chart for the America's Community Banking Index, ACBQ. ACBQ is a market-weighted basket of more than 500 smaller publicly traded FDIC-insured financial institutions, and these banks have overexposure to construction and development loans. Many community banks are ripe for failure. 2,368 lenders have construction loans that exceed total capital. 467 publicly traded banks have risk exposures to C&D loans that exceed regulatory guidelines. The year-to-date low is 203.112 with the 50-day simple moving average at 126.93 and the 200-day at 246.24. My fourth blip looks at the condo and commercial real estate conundrum. The Street Tracks Dow Jones Wilshire REIT Index, RWR, is actually up 6.3% year-to-date. RWR is 85% commercial real estate loans and includes some condos. The year-to-date low is 58.36 with the 50-day simple moving average at 69.69, the 200-day simple moving average at 74, and a new year-to-date high set recently at 76.06. The American Institute of Architects just reported a decline in their non-residential building index to 39.7, well below the 50 neutral threshold. I define the condo conundrum as the fact that even if you want to buy a condo with 80% financing, full documentation, and all cash down, you still may be turned down. Condo loans are an issue in specific buildings that are less than 70% owner-occupied. Banks charge a premium in terms of a mortgage rate to hold mortgage loans on their books. Banks may have to take control of some of these properties in what's called OREO, other real estate owned, when builders and developers can't get to the 70% owner-occupied status. This could become a catalyst for bank failures. Send your comments and questions to support at rightsideadvisors.com. That's today's 4 in 4. Enjoy your day.